Good evening, everyone. How you guys doing? Welcome to your market updates for November. So today we're gonna have a great time talking about the stock markets. I have a lot to tell you guys about what is it that we're expecting with the stock markets for next year. We're gonna talk about what is actually happening right now, what indicators, and what is actually going to happen over the next couple months. Now, no one has a crystal ball, but history tends to tell us a lot. And today we're gonna analyze a lot of things. Now, let's get right into it, and I will share my screen over here. Now, as you guys, there's a lot of clients that might be here today, but there might be some families that might not be working with us. So let me tell you a little bit about myself. I'm Miguel Rodriguez. I'm one of the senior wealth advisors here in Guerra Wealth. I have a master's in finance. I'm a retirement income certified professional and been here for the last 5 years, 6 years. It feels like 20 years. And it's going to be, I'm actually very happy to be here. It's a great family here in Guerra Wealth. But enough about me. So a little bit about Guerra. So our clients' money is held at Fidelity Investments. Here in Guerra, we don't hold our clients' money. We use a regulated custodian, which is Fidelity Investments. We manage between $800 million to $1 billion across different investment vehicles. And for the families that we don't serve, this is good for you guys to see. Here in Guerra, even though today we're talking about investment management and stock markets, that's not only what we do. Here in Guerra, we specialize in 5 specific areas, which is number one, retirement income planning, which is one of my specialties. How can we make sure we have enough money and the right vehicles in place to put yourself through retirements and out of retirements? What is going to be the income strategy? In other words, and the withdrawal strategy out of your investments to sustain yourself throughout retirements. Because by having so, that could help you with taxes as well. So that's very important. Number 2 is investment management. How can we make sure you're getting more returns out of less risk out of your portfolios? How can we optimize your investments? Number 3 is my favorite one, is tax planning. So taxes, Uncle Sam, it's a big deal. You want to keep Uncle Sam away from your money, and you want to make sure you have the right things in place to keep more money in your pockets and for your families as well. Number 4 and number 5 is asset protection, estate planning, just protecting your wealth against potential lawsuits, medical bills, and those kind of scenarios. And lastly, estate planning. How can we make sure you have the right legal documents in place that once you're no longer here, it goes to the right people in the manner that you want your money to be given to those people? And most important, avoiding probates. That's one of the worst things that you could deal with, and your family as well. It costs money, it takes time, and they make the decisions with your money. But here, what you see on your screen right now is what we call the Guerra Freedom Plan process, which means the new families that we onboard here to become a client of Guerra, they go through 3 different phases. Phase number 1 is what we call the discovery phase, where we have a couple meetings, we get to know you, we understand you and your goals, and you will learn a lot about us. In those couple phases, in those couple meetings, we will be able to identify what are the areas that you might need some assistance with. We'll create something that I will show you now in a second. And then at that point, we go into something called phase 2, which is the execution phase. In other words, you will have many sessions across these 5 areas over the next 1 to 3 months where we could implement the right strategies for your financial plan. Phase 3, that's what we like to call freedom. That's when you have everything in your financial plan optimized, and then we will meet with you on a quarterly basis to make sure that your plan is up to speed with your goals, and everything that's happening in the economy, you're up to speed with that as well. And your plan is going to change. We want to make sure that we see you on a constant basis to make sure we're updating your plan as we go. Now, today, so let's talk about this. Today, we're going to break down what is actually happening in the market. What's going on with the performance of the market? Why has the market been so volatile over the last couple of weeks and couple of months? What are the key indicators that we are looking at? And also opportunities and risks that we're expecting ahead over the next year or so. So that's one of the main topics that we'll talk about. Sometimes we're very optimistic, but I have to look at the worst case scenario. Think about it. I'm the engineer looking at the boat and what could sink the boat. That boat could be the stock markets. Depending how your investments are set up, you might be taking too much risk and not getting the right reward for the amount of risk that you're taking. Or you might be taking too little risk and not getting the right amount of performance that your plan needs to sustain you throughout retirement. But let's get started. Now, where are we now? What is the stock market doing year to date? When you look at the stock market year to date, there's 3 indexes that we mainly look at. Is the S&P 500, which is the largest 500 companies in the economy. And that index is up roughly around 16.58% for the year. Even after the drop that we saw here through tariffs, the market has gone up very steady over the last couple months. And here, that's when we've seen this volatility over the last couple of months. Now, you see all the indexes in there, which is the NASDAQ, the largest 100 tech companies in the economy. Apple, Google, Amazon as well is in there, Microsoft, and as well, we have the Dow Jones. The NASDAQ itself is up 21.45% for the year. That's due to all this new innovation that's actually hitting the market through artificial intelligence. But we'll talk about that in a second. Now, over the last couple of months, it's been a little bit steady in the markets. It's been kind of cruise control. Over the last month, we saw the government shutdown, and that's why we saw that volatility. We'll get into that in a second, but let's zoom out a little bit more. Let's look at the markets itself over the last year. Over the last year, the S&P 500 is up 14.57%, and the NASDAQ itself, it's up 21%. Now, when you compare that to the Dow Jones, it's only up 10%. So you might be telling Miguel, I really like that NASDAQ index. Let's put all my money there. That's not the case. You're not diversifying. That's not really a plan. A simple index is not a plan. You need to have a whole mapped out retirement plan to be able to have the right things in place, because there's many different investment vehicles. All of them have a purpose. Now, the best investment vehicle does not really exist. If you're looking for that, this is not the seminar for that. I'm not here to tell you, hey, put all your money into this one single investment. That doesn't exist. There's many different investment vehicles that have different outcomes. The goal is that we tailor all those investment vehicles to your needs and your goals. Now, let's zoom out a little bit further. When you look at the economy over the last 5 years and the stock markets, the S&P 500 over the last 5 years, it's up 91%. We went right after COVID, market went up. Then the market went down through 2022 when inflation was as high as 9%. And the Fed, they had to raise interest rates to battle with the inflation. And also this year was midterm elections. But right after that, as you guys see, the market had a very nice ride up onto tariffs. And then right after that, market went up. If you look at the NASDAQ was up over 113% over the last 5 years. That's only invested into tech. When you look at the S&P 500, there's many different sectors inside of it, which is this right here. Tech is part of the S&P 500, but that's not the only thing that's inside of the S&P 500. So let's break it down by different sectors and see how each sector has performed for this year. So as you guys see right here, communications and information has killed it this year, up 27 and 26%. Again, that's mainly due to all the innovation through artificial intelligence, and all these massive companies are creating a lot of revenue, and there's a lot of optimism that's coming with artificial intelligence, driving the performance up. But if you guys think about it, look at the third best performing sector in the stock market, utilities, which is called the defensive sector. It's a very boring sector, but this year's the third best performing sector, up 18%. And industrials, up 16.94%. Now, if you look here, over the last month, the best performing sector has been energy. As you guys see, there's always the sectors, and the performance within sectors always rotating. You want to make sure that when you're building your financial plan, the money that you have in the markets, you might want to have an active management style to that money, because there's always going to be different opportunities that might arise. And if the market is going down, if you have all your money, let's call it in the worst performing sector this year, which is consumer staples. Now, consumer staples, they're necessities for the consumer. They're not wants for the consumer. Those are things the consumer needs to survive. The wants for the consumer, that's what is called consumer discretionary. But going back to this, if you had all your money in consumer staples, you'll be only up 1% for the year. You're underperforming the stock market itself, the S&P, and also inflation is eating up your money. That's when it comes to active management of your portfolio. And what we do here in Guerra is sector rotating across the different sectors, seeking for opportunities and minimizing the downside in the market. It could be a great strategy to implement to your risky bucket, to that portion of your money in the markets that you're seeking higher returns with that. Now, when we zoom out a little bit, look at the stock market, all the different sectors over the last 5 years. I'll give you a second to look at it in this column right here. If we see the best performing sectors, you're going to be shocked, because you see technology. That's kind of obvious as we've seen all this innovation. But look at energy over the last 5 years. It's up 173%. And this year, it hasn't been doing so good, except for the last month and 3 months, it's been killing it. But energy over the last 5 years is being one of the main players in the economy, in the stock markets. But you don't hear a lot of noise of energy in the stock market because you see a lot of people with the hype just putting all their money in tech. Tech itself, that's not a financial plan. That's just a sector. It's just a component of your investment strategy. It does not mean all your money should be in that sector. All the pieces within your financial plan speak to each other. You need to have a properly structured investment strategy, not have all the money in one single thing. There's many different type of investment vehicles. You have to make sure you have the ones that will drive you to that goal of yours. Might be income, might be appreciation, might be capital preservation, might be a balanced strategy. There's different things and different tools you could use for that. Now, let's watch this. Everything that we do, if you think about it, the stock market itself throughout history, going back to 1928, it's positive 73% of the time. So, Miguel, am I really worrying myself and stressing myself out just for 27% of the time that the market goes negative? Is that really what I'm doing? Yes. You're mapping out all these different things in your financial plan to prepare for the worst that could happen. But you have to take advantage, right? As the opportunities come when the market's going up, you need to have a healthy balance because there's something called risk of sequence of returns, which means if you retire and the market plummets, call it 30% all at once, you're taking income out of your investments at the worst time possible if you don't have the right thing in place because you're setting at a loss. It will take forever for your money to recover. Let's put it this way. You have $1 million and you need, call it yearly, $60,000 and the market goes down 30%. Your $1 million goes down to $700,000 and then now you're withdrawing $60,000 out of $700,000. It's not the same thing withdrawing $60,000 of $700,000 than $60,000 of $1 million. You go from withdrawing 6% to much higher than that. I think we're all on the same page. So let's move on real quick. Now, I've been talking to many different families and they're worried about the government shutdown, which I could understand, but we have to see what history tells us. How does the market actually perform when the government is shut down? If we go back to 1976, the average return to the stock market itself when the government is shut down, it's 0.3% on average. And it's 62% of the time positive when the government is shut down. So, and the government, basically the S&P 500, the stock market itself is being positive over the last 6 shutdowns. Now, the S&P 500 during the shutdown, that's been the longest one, over 43 days by now, it's up 2.2%, hitting 8 new all-time highs. So the market is here, even to all the, let's call it the unknown and all the fear of fiscal policy through the government, it's done pretty good through the shutdown. But as you see, there's a lot of rotation that has happened in the sectors over these last 43 days. Now, a couple things I want to talk to you guys about. Earnings are happening right now. Companies are reporting their earnings, and we've been having the best earnings going back to 2021 when margins for, when you look at operating profits, the profit margins for this company, it's up right now 13.4% above the long-term average of 9.1%, as you see here in this bar on the right side. That's very good. The companies, even through everything that's happening right now, they're making a lot of money. That does not mean that the consumer is not stretched out. That does not mean that the consumer is not struggling. But these massive companies are making a lot of money. Now, that's despite high interest rates. That's despite high inflation that we had back in 2022. That shows you how efficient all this new innovation and these massive companies are to adjust its business models to make more money within the business models, to have more profits in that sense. There's a lot of fear out there, but you have to really understand how are you investing your money and what are the different investment vehicles that you have and how does that correlate with everything that's happening right now in the economy. Now, if you guys have any questions, by the way, you could drop it down in the chat below. I'll be taking a look down there once in a while, just to make sure that I answer everything. But let's move on. What's going on with inflation and interest rates? So as we saw back in the ending of October, rates went down, but the Fed wants to know what's actually happening with the data. What is the report saying? What's a jobs report? What is the inflation report? We don't really have that information if the government is shut down. So Jerome Powell doesn't really want to make a decision if he doesn't know what's actually happening in the economy. And there's a tool that we use that's called the CME Fed Watch tool that prices in live what is expected to happen in the next Federal Reserve meeting. If we look here, the next Fed meeting is on December 10th, and there's a 67% chance that rates will go down in December 10th. That could change very fast, as I mentioned earlier. This gets updated on a minute basis based on the headlines that was actually happening within the economy. The government is expected to open, but as we know, many things could happen in there and they could delay the shutdown. And let's see what happens with that, because at the end of the day, it's the government. They make the decisions there. Now, expectation for interest rates. That's a conversation that I have on a daily basis when it comes down to debts, investments, money markets, CDs, and as well as housing. The expectation for interest rates is for next year to steady, just go down. And at the ending of next year, the Fed rates should be around 3.04%. Again, as I mentioned all the time, that does not mean if you go buy a house, you're getting that nice interest rate that you were getting back in 2021 in the mid 2% to 3%. That does not mean that's going to happen. That means that the borrowing cost for housing and many other different debts is going to get cheaper. Business owners could access capital at a cheaper cost, and they could use that money to hire more employees. That's the goal, right? They need to hire more employees. Sebastian, he could hire more Miguels, meaning that will create employment. Miguel gets that job. He could go to someone else's business and spend more money in their business. In other words, when they're lower interest rates, they're injecting more money into the money supply. Now, a couple of things with that. That could create some risk, right? That could cause inflation, which is what happened back in 2022. That's what is called the soft landing. They need to be careful how fast are they lowering interest rates with what's happening in the economy. That's why they base their decisions in a lot of these different reports that tells them live what's happening in the economy. Now, if rates go down too fast, that might not be good for the market. Inflation might go up. If inflation goes up, that will create a lot of fear in the stock market, and the Fed might have to raise interest rates again to battle inflation. That's scary in that sense. The euphoria that's in the market right now will not be there at that point. There will be a lot of running around, and that's when you need to make sure that your portfolio has the right investment mix and you have the right money in the right buckets. And by the way, even through all this artificial intelligence and all this different hype in the market right now, there's different investment vehicles that you could participate in all this hype through AI and different things without having to expose too much risk within your portfolio. There's many things you could use for that. And for our clients, we have a couple particular investment strategies that we are using for that. I actually just met with a family right before this. We were talking about it. We were getting ready for 2026. It's crazy. 2026 is right around the corner. It feels like 2021 was yesterday. But we were getting ready. What is going to be the investment strategy for next year? Because a couple of things are happening next year. We have midterm elections where historically the market goes down. The market gets very volatile during such a year because the market doesn't know what's going to happen with the elections. There's polls, there's different things that the market prices in, the probability that a party might get elected, but doesn't really know what's going to happen. Now, if you see here on top, the volatility of the stock market, think about the choppiness in the ocean, is going to get higher from June to November. So if you go back to 2022, as I was mentioning earlier, look what happened to the market in 2022. I'm not saying the market is going to go down next year. The market works in different cycles. We've been enjoying very nice returns going back to 2023 all of the way until now. But in 2022, and in such a year where we have midterm elections, it creates a lot of volatility within the stock market. The fluctuation in the stock market that get higher and higher as you get closer to the elections. Now, also in such a year, we're heading into very unknown territories because we have tariffs as well. We haven't seen the impact of tariffs yet. It's a study that we're seeing out there. It could be good, it could be bad. It just depends on what channel you're watching. You're watching Fox or you're watching CNN. But at the end of the day, you have to make decisions for your money, and you have to understand what percentage of your money do you have exposed to all of these things right now, and what is the investment strategy within that risky bucket that you have in the stock market. What are the sectors that you're using? What is investment strategy? How often are you making changes? Based on what are you making the changes? Is it fundamentals? Is it technicals? Is it based on fiscal policy? Is it based on monetary policy? You have to understand that investment policy that you have there in your risky buckets. Now, as we're talking about many different, let's call it pessimistic things, and the clients that know me, they know I'm a very happy person. I'm actually always smiling. I just got married. I love my wife. And I just have to look at what is the worst thing that could happen, which is volatility or a market pullback or a correction that we could see. Now, this is something that I want you guys to pay attention to. This is very important. A lot of the news might be talking about this, but this is something that I have heard some families to be concerned about. And we are concerned about this as well ourselves. But we have a specific strategy that we're using to battle all this concentration that's happening in the market. Because right now, we're seeing the most concentration in the S&P 500 going back to the 1930s. So if you look at this chart right here, basically what it's telling you is the largest 10% companies of the stock market make up for 76.41% of the total value of the S&P 500. So think about this. The largest 10% of the companies make up 76% of the value of the index. What does history tells us, right? When the market was this concentrated, going back to the 1930s, look what happened after. When the market was this concentrated, actually less, 62% with the Nifty 50, which is kind of a similar situation a little bit, or the dot-com bubble, look what happened after. Right now, we're at 76.41. We have a very concentrated market due to all the innovation that we've seen through artificial intelligence. But what happens is there's a lot of fear of missing out. There's a lot of people jumping in the bandwagon and they're not protecting themselves. They don't have the right strategies in place. They don't have the right portfolio mix, which I'm very proud of that. For our clients, we're doing a very specific strategy. Yes, there's a lot of hype through AI. We have things in place to participate through AI. If AI does not work out, we're still going to make money in all the different angles. Now, what do you need to do? You need to make sure you spread out the risk within your portfolio. There's different tools and investment vehicles that you could use that participate with AI if AI keeps going up, which actually that's the future, right? We could all agree that artificial intelligence might be there in the future. We're seeing robots, we're seeing a lot of innovation in different companies. Amazon has a bunch of robots in the factories. It's just a matter of protecting yourself. If the market happens to pull back, what does that mean for your financial plan? Are you going to go back? Are you going to need to go back to go to work? Are you going to be forced to work again? Are you going to lose that option to be retired? That's not the goal, right? The goal is that you're protecting yourself and you have the right risk tolerance within your portfolio, spreading out the risk, using the right mix in your portfolio, and having the right things in place for your goals. Now, this is very important, guys. We're in a very unique time. Rates going down. We're heading into 2026, where we have midterm elections. We're expecting a lot of choppiness in the market. The market is very concentrated. History tends to repeat itself. We're not saying the market is going to go down next year. We are getting prepared that if that does happen, we're protecting our clients' money. If the market does go up, we're positioned in a way that we're still going to make money for our clients, but in a very particular way for our investment strategy. And if you're a client of ours and you want to discuss that further, Miguel, I want to know more about that. Can you walk me through that? So at the end of this webinar, there's going to be a QR link. We could talk about it. I could walk you through what is it that we're doing in more detail. If you're a new family and you want to go through all this process, at the end, you can book a session with us. Now, let's talk about next year opportunities and risk. So I know I have said this many times throughout this year, and I feel like my viewers throughout the entire year, we've been through so much. And who would have thought now in November, after going down so deep there in with tariffs in April, we'll be at these highs in the market. Depending on who you're talking to, you might have not been that optimistic with the market. Now, risks that we are seeing. So with the market, risks that we're seeing, trades. Tariffs is still a risk because it could be a little volatile. It could be decision making there in that process that could affect different sectors. So you have to stay active with your strategy, be quick with the rotations within your portfolio. As I mentioned earlier, sector rotating is a big deal. The market moves very fast. You do not want to get caught with your pants down in such a time. Also, if rates stay higher, that's another risk, as I mentioned earlier. If rates stay higher, there's a lot of people that are struggling out there to access capital. That has to do with real estate, stock market, and business owners. They want to access capital to invest into the business. But I do understand the fundamentals behind the Federal Reserve that if they lower rates too fast, that could cause inflation to get higher. And as well, today, here's something that I have told to every single family that I serve. And in here in Guerra, by the way, we serve over 3,000 families. And again, I'm blessed to be here. Um, it is the best time to make sure your portfolio is aligned with your risk tolerance. Your portfolio since 2023 might have grown too much in different sectors that it might be the right time to align it according to your goals and your risk tolerance. You don't want to do that if the market goes down because you're selling at the bottom. You want to lock in gains, distribute the money, go into different strategies to still seek performance, but spreading out the risk when the market is at all-time highs, right? Now, next year, this visual says it all. I showed it last time. That's what we're expecting, a roller coaster. The market is going to be choppy next year. And you have to make sure, again, you are positioned in the right way going into such a unique year where historically, again, and all the different factors are happening with fiscal, monetary policy, and the economy, it's a lot of the unknown, and the market does not like the unknown. If one of these massive institutions have a bad earning, that could affect the stock market itself due to all the optimism behind artificial intelligence. We have not seen all the fruits behind that yet. You want to make sure the risk between your portfolio is actually spread out. Make sense? Now, let's talk about the housing market. I really love this topic, and I love my real estate investors. One of my biggest clients here in Guerra, he has over 30 doors. He makes a lot of money through the real estate, but I really enjoyed talking to this gentleman. And all these properties, he bought them in the 1990s to early 2000s. He makes a lot of money out of real estate. He has many different investment vehicles through us. So he does not only need real estate. He has many different tools, but he's done very good for himself. It's not the same markets. Real estate has gone up tremendously. Wages have not kept up with the price of real estate. If you see here on the right side, the income needed to buy the average price of a home today is $120,000. Well, the actual average income here in the US is $80,000. That's a 50% gap. People are not able to afford these prices, and as well with these interest rates being so high. But again, the Fed, I understand what they're doing. You have to be careful with inflation because that could cause chaos in the markets. Now, watch this. On the left side, the average household needs a raise of $28,000 to afford a home today. Again, the average income is $80,000, roughly a raise of $28,000 to afford that house throughout the US. That's a big raise, right? If you think about it, that's over 20% raise. I don't know many business owners that give raises of 20%. On average, it's 3 to 5%. Great business owners, which employees provide a lot of value, they might see 10 to 15% raises on a yearly basis. But this is a little bit concerning. There's different markets out there for real estate that are creating a lot of opportunities. So if you like real estate, we have a specific calculator that we use for our clients. I used it recently for one family that we were looking to buy. Miguel, I want to buy a property. Fantastic. What is the goal of that property? Is it appreciation? Is it income? Miguel, it's income. Let's run the numbers. The profit was negative on a monthly basis. But they were told by the person selling the house to them, it was a great investment. But the purpose of that investment they were making was for income. There was no income. So that was not the right property for them. We found one later on that made sense for them, that the return was around 10% on that property. Fantastic. That was their goal. But now I could tell you that was not in Miami. It's a tough market in Miami. They were looking at a different area. And again, if you're a new family or an existing client of ours, you want to check that calculator out, reach out to us at the end of the webinar so we could have a session and run the numbers with you. Now, going back to this, as I mentioned a little bit earlier, today, when the market's at all-time highs, is the right time to make sure, and these are the 5 different buckets for retirement planning: cash, safe growth, risky, healthcare planning, and legacy. Is the right time to make sure across these 2 buckets, you have the right mix. This bucket over the last couple of years has grown tremendously. It might be a wise time to talk to your financial planner or your financial advisor to see if it makes sense for your goal to lock in a little bit of gains and switch it towards the safe buckets. Because your tolerance, that healthy mix, call it a 60-40, 60 safe, 40 at risk, might have gone up to 80-20, 70-30, and it might be a good time just to rebalance that strategy for you. Now, going back to this, the Guerra Freedom Plan process. And let me see if anyone here in the chat has any questions. Give me 1 second. See if I could answer a couple questions. Here in the chat, let me go back over there. I apologize. Let's see. Crypto. That's always a question that I get. Miguel, what's your top process with crypto? So when you look at the buckets, right? Crypto is in the risky bucket. It's a tool that you could use within a risky bucket to seek appreciation. Now, crypto, as we know, is very volatile. You want to make sure you have the right balance within your financial plan. Don't have all the money in crypto. That's not really a financial plan. You're just putting everything into one single investment category. So crypto, yes, it is very volatile. What's our expectation for it? It's going to remain volatile. Crypto, historically, it is very volatile. Now, let me see if there's another question here. What is a withdrawal strategy? Okay, so a withdrawal strategy, think about it, you're retired today. You have many different accounts. You have a 401k, you have a Roth IRA, you have an investment account, and then you might have an HSA, some life insurance. A withdrawal strategy, once you get to retirement, you need to make sure that you understand and you have a reasoning why, where are you taking the $7,000 to $8,000 that you need monthly from which of those different buckets? Because those different buckets might have different investments within them. That's a complicated part. By you having the right mix for the withdrawal strategy, that could help you make sure your money lasts longer, saves you in taxes, and you have better performance for your money. So it's not that simple. It is very complicated. So you need to sit down with someone from our team, and map out a withdrawal strategy for you on a yearly basis, or for the next 5 to 10 years. Where are you going to withdraw the money on a monthly basis to maintain the lifestyle that you're accustomed to? Very good question. Now, give me 1 second here. Alrighty, guys. I do need to wrap up. So, a couple of things. Just reminding you guys, the Guerra Freedom Plan process is very unique. The new families that we serve, they go through a 3-phase process. Number 1, the discovery phase. We get to know you, your goals, your aspirations. You will go through a planning process that we will look at all the 5 areas of financial planning. We're going to give you a grade, okay? Don't get upset at us. We are going to grade you based on how you have everything structured right now. We'll stipulate here how you have everything structured, the outcome of how you have everything structured right now, what's going to happen if you do nothing, and what is the impacts that we could have in your current financial life. Now, based on that, after those couple sessions, most families are ready to make a decision. Hey, am I ready to work with a firm like Guerra Wealth, where they look at all the different areas for my financial plan? For our clients, we hold their money at Fidelity Investments. We're just the advisor to the accounts, helping them make those decisions. Now, the phase 2, that's the fun part for someone like me. That's the execution phase. How are we going to implement all the different things in your financial plan? Well, we have different sessions. You cannot do everything in one single day. I had one family that tells me, Miguel, I'll take out 8 hours of my day to meet with you. I'm so sorry. It's going to be too much information. You're not going to be able to digest everything. And there's a lot of decisions we need to make throughout the process. And by the way, they were engineers. I love working with engineers, very logical people, numbers people. And so that's why this process takes around between 1 month to 3 months, where we will have a retirement planning session, investment management session, a tax strategy session to see the 3 tax buckets: Roth conversions, RMD planning, capital gains planning, tax loss harvesting, IRMA surcharges. Important if you're a high income earning. What is IRMA? What does that mean to you? Charitable planning, and one of my favorites, business tax planning. I work with many different business owners where we have implemented many different things for them that have saved them thousands of dollars in taxes while they're still operating the business and saving towards the future. Very important. I actually love working with business owners. Now, the last 2, asset protection, long-term care planning, disability income, life insurance, umbrella insurance, many different things we have to look for yourself. And this last one, huge. The right corporate structure for your business, real estate, and your overall financial picture if you're a business owner. And lastly, estate planning, which is having all the legal documents in place to distribute your assets to your family when you're no longer here. And then phase 3, freedom, right? That's when you could go on your cruises, you could go traveling, enjoy your grandkids, enjoy your family. I actually just met with someone This lady, she's turning on February 60 years old. She's retired. She's done an amazing job throughout her career. She has a whole mapped out financial plan, and it was a very nice meeting because she's turning 60 next year, and her goal was at 60 years old to travel to Italy with her family and spend over there a couple weeks. So I was able to give her the good news. Hey, you could afford to do so. You could even afford to take your kids if you wanted to. Your accounts are performing great. So you have the right structure within your financial plan to be able to do that. You deserve that luxury. You work so hard through your career that now you're able to do so. You earned this. Because what happens is a lot of families, when they get to retirements, they might be scared. Why? Because it's easy getting there. Think about climbing Mount Everest. It's easy getting there. It's not easy. Okay, I never done it. But more people die on the way down than climbing up. So climbing down, that's when you have to have the right things and the team in place to help you with this. Now, with the families that we serve on a yearly basis, we do ongoing tax planning, estate planning reviews, and many different things. And we have a whole team here in Guerra of over 65 employees that helps us, the financial advisors, serve the clients that we have here. Now, here's our leadership team, which here's myself, here's the team. It's 65 employees here in Guerra. It's not only Miguel. I have a team that helps me. I have my team that helps me manage my clients. Having a single person it's too much, guys. You need to have a team that specializes on different areas to help you accomplish your goals. That's what sets us apart. This process right here, that we put the families that we serve and how we serve them, all the planning that we do, and the team that we have. We have something special here, and we work with great people and we serve great families as well. Now, guys, if you guys would like to have a session with us, if you're one of our existing clients and you might want to book a financial review, if you haven't had one, please click this QR code below. And if you're a new family that you're not one of our clients and you would like to see how you have everything structured right now, or does it make sense to have a session with us? Hey, click it there, have a session with us, see how you're doing everything right now, see the areas of opportunity, how we might be able to help you. If you're doing fantastic, we will tell you, hey, you're doing an amazing job. Keep doing what you're doing. But if you're not doing so good and you might crash and burn, hey, if you keep doing what you're doing right now, you're going to get yourself in trouble. Here's the things that you need to do. All right, guys. Again, like always, it's been a pleasure to be here. I'm blessed to be in this position. I love what I do. I love this topic. And I'll